Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. Sitting across from me, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and Head of Research at analyst firm Aegis Equities, Head of Quantitative Strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And of course, for more information, please check out our people section at www.nucleuswealth.com. Yes, and hello and welcome to our next instalment of Nucleus Insights, and we've titled this one 2018 to 2028, Where to Invest for Australia's Lost Decade. So I'm really looking forward to this one. It's obviously been a pretty prime thought in people's minds given the recent market volatility, and obviously the news that's coming out with our increasing lower wages, or lower wage growth rather, and increasing housing debt. So this will be a fantastic little presentation. Our first off, let's have a look at our agenda. So today we're looking at, I guess broadly the economy itself, quietly dubbed the houses and holes economy, of course, and a bit of information behind that. This time is different. So our, I guess the overview being that what has worked in the past may not work in the future, and some evidence behind that. And then of course the key theme, which is how to invest and where to invest, given the information that we have. So I'll move on to our first one today. So houses and holes, or in this case, holes and houses. So we might look at our recent once in 100-year mining boom, with which of course I experienced a bit of largesse being an engineer over in the Pilbara. We're in the heyday, but of course that heyday is now over, and the champagne has been drunk, and now everybody has a small hangover. So what can you tell us about this there, Damien?
Yeah, so I wanted to try and paint a bit of a picture of the Australian economy and sort of where we've come from since the financial crisis. And there's a chart we've got showing at the moment. For anyone who can't see it, basically it shows that capex, mining capex in particular, and also energy capex, really took off in that period in the late 2000s and the sort of early part of up to sort of 2013, 2014, and since then it's dropped quite precipitously. So, one project itself was Gorgon, which was one of the biggest ones, and that was sort of 50 odd billion, which is about 5% of Australian GDP. So it was spread over a number of years, but just one single project made up 5% of GDP. And so what that meant was that sucked resources in from everywhere. And there were lots of other projects of not of the same size, but in aggregate they all added up to this massive boom that meant that the Australian dollar shot higher, trying to attract more workers into Australia, and wages shot up in the Pilbara, and things about
they did.
Truck drivers getting 3 times in there what they could get elsewhere, and people couldn't find employees in certain ranges because the whole world had this demand for, and in particular China had this demand for commodities, and was basically trying to send economic messages to Australia saying, redivert your resources to pulling as much of these commodities out of the ground as you can. The unfortunate thing is that we know minings go in cycles, and that booms are followed by busts, and that there's a lot of talk about the next phase of the mining cycle being increased volumes, and that's certainly true, that the volumes that we're pumping out are considerably higher than what they used to be. The issue is you need about 90% fewer employees. So the setup is where all the money is, and once you're producing the volumes, you don't need the employees.
Sure.
And secondly, the money that comes. So in the first stage, we've got money that's coming in that's going to subcontractors and truck drivers and earth moving and all this stuff, all this money sort of flowing into the rest of the Australian economy. When you've got it into operational mode, though, now you're starting to make profits, and those profits are generally going to foreign shareholders, especially in the case of the big energy plays, but also BHP and Rio, which people like to think are Australian, are a majority foreign owned, and so the profits flow offshore as well as to sort of local investors.
Okay, sure. So obviously mining's cooling off in terms of an investment sort of resource, but let's have a look at the other side of our big boom, our big GFC country saving boom that we had.
So as the mining came off, what we did was we lowered interest rates as fast as we possibly could to bring the Australian dollar down, and also to get the housing market going, and that was successful. So we've spurred a now we've spurred, I don't know if you call it once in 100 years, but certainly once in a long time, generational housing boom that we're showing some graphs of dwelling approvals. But I guess the key note is that in the 80s and 90s, 50,000 apartments was the norm. In recent times, it's been well over 100,000, and probably as much as 120,000 in terms of dwelling approvals for apartments. So it's sort of, we've had this massive apartment boom running at sort of 3 times the normal level, or at least double the normal level, which is then flows through the rest of the economy. And often these types of housing booms, in terms of the construction booms, are actually very that money bounces around the economy a lot, because you get a lot of subcontractors and a lot of tradies, and that money gets spent, and so it's often got what they call a good multiplier effect.
Absolutely,
in terms of that money.
Sure thing. And it is remarkable that over the last 35 years that it has been so consistently around that sort of mean on both the housing and the units, save for the last sort of decade or so, where the units have just shot for the sky.
Yeah, exactly. And it's probably more just the last 5 years. And so basically what's happened is we've rolled out of this historic mining boom, and as we're coming off, what we've done is we've thrown all this into a housing boom.
Yep.
And now the housing boom's coming off, and the question is, what's next?
Sure. Yep.
And how long have we got?
Okay. So I guess what else have we got, Damien?
So the two choices really is services and manufacturing, and I'll show a couple of charts on the manufacturing and things like that next, but both of them really rely on a low Australian dollar. Our big issue is on the manufacturing side is we've hollowed out our manufacturers. So we had this Australian dollar that went to over $1 US and up to $1.10. And what that meant was manufacturers shut down left, right, and centre. We've had the car companies have all basically shuttered their Australian operations and are just in the process now of sort of pulling the last pin on closing them down.
Yep.
So the next graph sort of shows you this. We've got a graph of manufacturing that's sort of basically manufacturing capex, which is sort of showing the similar types of signs that the actual amount of capital expenditure is very low at the moment, and unfortunately manufacturing is one of these things that takes a long time to turn around. So once somebody's made a decision to leave a country, the Aussie dollar falls, they don't suddenly
switch back over again and come back in. Yeah,
exactly.
And just obviously, there was elevated capex through the, I guess essentially through the boom. Is that the bulk of those peaks? Do you think would be mining boom related, or
some of it is? Yeah, certainly. I think it's worth noting there as well that as there is a certain amount of ongoing capex you need within manufacturing. So as the places start to shut down, some of it's a lot of this is the ongoing capex that disappears, or your factory. You basically go, well, I've got a factory that's lasting me 20 years and it's finishing up in mid 2015 or something like that. And saying like, well, I won't start a new one.
Okay.
I'll start the new one in the US, or I'll start the new one in Europe or China or something like that.
Okay.
So these decisions take a long time to come about. They're not they're not spur of the moment. But in aggregate, they all add up. And I think on the services side, though, is a bit quicker.
Yep.
The services side tends to be, even in the financial services and places like that, some of the global companies will be looking and saying, I want to put a new analyst on, or I want to put a lawyer on for the Asian area. Do I put it in Australia? And when the Aussie dollar is $1.10, and you're looking and going, well, an employee there is costing me twice as much as an employee in Hong Kong or Japan or Singapore, and so that's where you put your employee. And then as the Aussie dollar comes down and as wages normalise a bit more, then you start to say, okay, well, rather than hiring the next person in Singapore, I'll actually hire them in Australia.
In Australia, okay. And I guess leading on there with the Australian dollar. So thoughts on the dollar going forward, I guess, and where it's been.
Yeah. What I might do is I'll probably forward anyone back to that, but basically the idea is we have the expectation it's lower, and I think from this perspective, on a long there's two sort of angles you can play. One is the sort of short and medium term angle, and we've got some reasons for thinking it's going to be lower over that period of time. And the second one is just this in the broad scope of things. What are we expecting? And the lower Aussie dollar fits that as well. So sometimes you're sort of in a stage where you might expect the Aussie dollar to rise because of short and mid-term factors, but over the long term is fall.
Okay.
And what we're saying is that over the long term, we need an Australian dollar lower because we've come off these two historically high booms. We actually need to get the services and the manufacturing sector going, and I guess a gift from the gods from overseas of some big spending. We need a lower dollar for that to happen.
Okay, sure. All right, very good. And I guess then looking into one of the other big inputs, of course, for manufacturing and to a degree perhaps services, but certainly with manufacturing is energy prices. And we've got a remarkable graph here, just watching it hockey stick from about 2010. Up until today, although there has been a little bit of a cooling there in the last sort of couple of years. So let us fill us in on where we're looking for retail energy prices.
So you basically double the price in over 10 years almost. And I think the thing for this, and we've titled that it's a little bit tongue in cheek. This time is different, but I think So I've spoken about this house and holes economies, and what I'm saying with this time is different is saying, well, what other factors are out there at the moment that we should be cognizant of that are going to change the way this recovery or the end of the boom happens compared to other times. So Australia is blessed in terms of energy. We've got very cheap coal. We're one of the larger exporters of coal.
Mm-hmm.
We've now just become, or we're just in the stages of becoming the world's largest exporter of gas. So we've got plenty of gas, we've got plenty of coal. We've got excellent solar.
I was just going to say we don't seem to be using our own gas and coal, but anyway, solar I think is another story. But
solar's the best, some of the best solar resources in the world, and the wind's pretty good as well.
Mm-hmm.
So from an energy perspective, Australia is blessed with low cost energy. Unfortunately, we actually have expensive electricity.
Yeah.
So there's been a range of things you could go into this. This could be a whole, and probably will be a whole topic on itself as to, and we have spoken in the past about it.
Absolutely.
But the big issue, the bullet point behind all that is, despite all our benefits and all our natural advantages, we actually do have quite high electricity at the moment relative to other places in the world. And so it would be great for manufacturing to come back, but manufacturing is facing this headwind now, is that if you're a manufacturer that relies on electricity, it used to be you could look at Australia and say, well, yeah, the Aussie dollar's high, but at least electricity prices are low and coal's cheap and gas is cheap and all that type of stuff, so that I've actually, I can keep my manufacturing in Australia on that basis. And now we've got the problem that the manufacturers that are using lots of electricity are now thinking, do I shut down my Australian operations and take it elsewhere because their electricity prices are so high?
Sure.
And so that just means the Aussie dollar's got to be even lower to make up for that.
Yep. Okay, very good. And of course, we'll move over to another. This time is different, and it's Australia's big elephant in the room, which is of course our sky-high private debt. So we've got a terrific graph here showing over the last, 150 years or more of how public debt's sort of been brought under control in relation to GDP. But once again, we've seen a skyrocketing of public debt, of private debt. Beg your pardon. So this is certainly different, I'm sure.
So when you've got low levels of demand and things like that, basically you can get through the periods of low demand by spending up big
Yep.
and going into debt to do so. We have very little scope to do so on the private debt side. So we've lowered interest rates. We've pushed everyone into this housing boom to try and keep the mining boom's finished. We want to keep everything going.
Yep.
Pushed everyone to the housing boom by raising the debt levels, which were already pretty high.
Mm-hmm.
And that sort of left us pretty much no scope to move on that front. There is a fair bit of scope on the government sector side. So we could certainly spend up big on the government side.
Yep. Okay.
And maybe that's what'll happen.
Maybe that's the answer.
Yeah, maybe, and that could push the whole adjustment process further out.
Yep,
if you do that. So you could certainly go through a period of 3, 4, 5 years of going into massive amounts of government debt to keep everything ticking along at the moment.
Yep.
Before you run out of scope on
Which
that
is
front.
a bit of a political, a colourful political situation to see yourself in, I'm sure. But
yeah, absolutely. I mean, whichever party's in power, I'm sure will when they're not in power, they've always got things about got to keep debt constrained and all that type of stuff. But if you're in power and that you've got to increase debt to keep employment high or keep employment from falling too far and
just keeping demand on the boil as well. Yep.
Then you'll probably lose whatever inhibitions you had about the debt and decide to try and keep the party going as long as you can.
Sure. Okay. And our final, I think it's our final this time. Different. Oh, second last one. Sorry. Is of course the change in demographics. So we might just quickly, if you want, just give us a quick run through of what the dependency ratio is before we dive into the graph there.
Yeah, so dependency ratio is the amount of people that are not working versus the people that are working. Sure. So you've got, so that takes into account both young people and people who are retired. So we went through this period from the 60s until very recently in sort of 2012. We sort of bottomed, or 2010 to 12, we sort of bottomed.
Okay.
Where we went from 60-something% of 65% of people not working versus 35 working, and then that fell right back to below 50.
Okay.
And now we're back on the way up. So that's two factors. One is the baby boomers. So the baby boomers were born in the 60s and they weren't working, and so they then progressed into work.
Okay, sure.
Women also, the amount of women working increased quite significantly over that time period as well. So we got this huge demographic component moving through, and now those baby boomers are retiring. People are living longer. We're having fewer kids.
Yep.
And so where that dependency ratio has changed. So sort of a headwind a tailwind for the economy all the way through is now turning into a bit of a headwind.
Okay, sure. And I guess from an investing point of view, sort of how is this relevant, or where does this how does this play into where things are going?
Yeah, it's going to make any adjustment process more difficult, basically. That you could... If you've got improving demographics, then you can sort of you get a little bit of a free kick in that you can run up some government debt in the knowledge that I'll have more workers next year and more the year after, and those workers will then help pay down that government debt over time.
Yep.
Whereas when the dependency ratio flips, now you've actually got the opposite problem. Your healthcare costs are rising. You've got fewer people working. If you start raising taxes on those people, then those people will pull back consumption, and then you start you create your own issues.
So essentially, in a nutshell, what's sort of worked in the last 40-odd years is going to need to be reviewed as to what's going to happen in the next couple of decades.
Yeah, absolutely. And this is one of those ones it's not going to change anything by the minute. It's just going to be a slow, inexorable change in that things just aren't quite the same as what they were over the last 40, 50 years. And
essentially just another thing to add onto the pile in conjunction with everything else that is different. So very good. Okay, and our final one is the rising inequality and also the lack of demand. So you might want to quickly run us through these ones.
Two sides of the same coin. So basically what we're looking at is that in broad terms, if you take $1,000 and give it to somebody who's a billionaire, chances are they're going to throw it on the pile and not spend any extra money. If they're not spending the money they've got, there's no reason for it. You take that same $1,000 and give it to somebody in the lowest socioeconomic demographic, it's straight out into the market, whether it's paying down debts or living expenses or whatever it is.
Sure.
So we've had this significant rise in inequality over the last 20, 30 years, and it's certainly started to increase as central banks have been pumping lots of money into the economy. We've then seen asset prices have then shot up, and so particularly housing prices. The average sort of whether it's a nurse, teacher
Yep.
type person, fireman type
Primary
person.
services sort of thing. Yep.
20 years ago could afford to buy a place somewhere in the
Where they
city,
worked.
where they worked exactly, and those people are now generally sitting on $1 million plus properties, and their kids in the same industries or even more highly paid jobs can't afford to buy the same houses in the same areas.
Yep.
And so basically we've seen a push of money into particular demographics. Sorry, into particular, well, demographically, but also there's been a rise in income in the asset value of the richest people.
Sure.
At the same time, wages growth stagnated, and that's we've got a graph there just sort of showing how wages.
It's a slow burn, but it is on the decline. Isn't it?
And wages growth itself is sort of plumbing, all-time lows at the moment in real terms. So we've got this problem: is that not only have we got a wages growth problem, we've also got more assets sort of ending up with the richest people. And what that means is, and we've got low inflation as well, and so the whole net effect is that you get this low demand coming through.
Yep. Okay.
You could paper over that by increasing debt, which we did,
which we have. Yep.
But you've reached the limit now. There's only so much you can so much debt you can throw. You can take post to somebody on a low wage and say, well, you might be on a low wage, but let me lend you rates lend you at
lower rates,
interest
higher
rates,
levers,
so you can spend more money but at a certain stage, that dies off, and so that game sort of reaching the end as well.
Sure. Okay. So look, they were our. I guess this time it's different facts and figures for locally, but let's have a look internationally now as well. So obviously we've got the US boom and bust. So
yep, that's right. So we're in the midst of a mini boom. So we've got a spending. So US personal consumption expenditures graph up at the moment, and it's certainly lower than where it was, but it's sort of running in between the sort of 2.5% and 5% in terms of the US, and right now it's sort of headed towards the 5% level. Plus we've got these tax cuts coming through, and sort of this big push in the US. There's from Trump to sort of, I guess, try and engineer a bit of a boom.
Yep.
So from my perspective, they're facing most of the same issues as Australia. That's going to push that growth even higher, but at some time we're looking at a bust on the other side of that. And they have by putting through these tax cuts, they've sort of eroded their tax base. They're basically, everything's pro-cyclical. Try and make the boom bigger, throw more gas on the fire.
Yep.
And at some stage, though, when it all comes off, is that they'll then be left in the position of saying, well, we can't afford. What can we afford and what can't we afford? Do we need to raise taxes? Well, raising taxes just as demand's coming off is not something you want to be doing.
Work. No.
And so, they're certainly creating issues for themselves. And so the big thing, though, is that the US consumer tends to drive the world. So over the next couple of years, what we could very much see is a bit of a gap filler for the Australian economy and for other economies, in that we've got this US consumer booming, and that's going to raise demand levels right around the world. So we've got this inequality problem and debt problems, but if the US is out there increasing their debt and spending money that they don't have by doing that, then that could easily paper over some cracks for a couple of years.
Okay. Yep. Sure. So a bit of a positive contagion effect for a change in the world markets.
Absolutely. So we've got sort of a positive on that side. The other this time is different internationally is China.
Of course, our major trading partner, and seems like a definer of our fortunes these days. But anyway,
yeah. And so I've got two graphs from them. One is just showing that the capex levels they're running, so the capital expenditure, the amount they spend on roads and hospitals and airports and all that type of stuff, is basically double what pretty much any other economy's ever done in terms of a percentage of their total GDP. So they're basically running it at 50% levels for the last 4 or 5 years, and they've run it well over 40% for the last almost 20 years, and so they're basically running at levels that are much, much higher than any other economy's ever done. And what that does is it creates all this excess capacity within the Chinese economy and helps deflation around the rest of the world. The issue is, though, that has increasingly become debt funded, especially over the last 5 or 10 years. And that's this next chart I've got there,
sure,
which is showing that US non-financial debt to GDP went from sort of 100% in China in 1995 versus sort of closer to 200 in the US.
Okay,
and now they're both at sort of 250. So US has risen slowly.
Yep.
Well, relatively quickly, I guess. But in a relative sense, the Chinese debt has basically gone up 2.5 times, and that because the issue as well is the debt they went into in 1995 was actually pretty good debt because they went into debt. The growth rates.
Yep.
More than
so the bang for buck effectively that they were getting was
much
good
higher.
back then. Yep.
Yeah,
okay.
Yeah. Invest $1, I'm getting a 15% growth rate in the economy, so that dollar comes back pretty quickly.
Yeah, sure. Yep.
Whereas now the growth rates are slowing, they've got all this excess capacity, and the debt's just now mounting up.
Yep.
So that's sort of again reaching this point where something's got to give. We're expecting that China will slow as they'll use the strength in the US to sort of slow their own economy back.
Okay.
But it's certainly an issue is that commodity prices can't do what they did before, and China's not going to be what China did over the past 20 years. They cannot do again.
Yep. Okay. And so certainly different this time
Yes.
over the next 10 years. All right.
Yeah.
Fantastic. So our two big trading partners there covered off. Let's move now into an overall outlook on given all this information and where we're looking going forward.
Where do you stick your money? Yeah. So the playbook, I've sort of got basically a 4-step playbook to this. The first thing to know is that it's late cycle, so we've been through this massive boom and longest period in the US without growth, without sort of a fallback, and Australia's sort of been through a record number of times without a recession. We've got a few quibbles over how that's calculated, but
Sure.
certainly a very long period. So the key thing right now is protection. Is you don't want to get too excited and play too much on the basis of the fact we've been so long without a recession doesn't mean that the chance of having a recession has gone away.
Sure. Yep.
And it probably makes things worse at a certain point. So that's our first point, is we want to make sure we're trying to protect our assets. The second part then is looking for assets that are going to benefit from a lower Australian dollar.
Okay.
So we've spoken about how Australia's going to need a lower Australian dollars to get the manufacturing and the services sectors going, and so within Australia we've got to look for those types of assets that are actually going to provide us some upside when the dollar falls.
Okay.
The third bit is there will be a time to aggressively switch into Aussie dollar assets, and it's not yet, and it's still a fair way away. But in the back of your mind needs to be this factor of when the adjustment really starts to happen, and when we see and you could quite easily see some real weakness in the housing market. You could see the Aussie dollar fall to the sort of 50s and 60s levels. You could see stock market's down. Like there'll be a lot of fear around. You need to be thinking, well, this is my opportunity to get into these Australian assets.
This is the entrance time.
Exactly.
Yep.
And so that's sort of switching in with that last bit, is that fear and greed are your biggest constraints. So that what we generally find is that when markets go through tough times, retail investors tend to step away.
Yep.
And that's usually the time when they should be investing.
Absolutely.
And at the flip side, when markets have been running hot and you've been getting 3, 4, 5% months, is when everyone's thinking, wow, that was great, I knew I should have invested, let me put some money now before it's too late.
Okay.
So flipping between that fear and greed is going to be the biggest thing most investors need to look at. And that's why, for a lot of investors, professional investment advice really works out well for them, because it's at the time when you need a manager who's making these asset allocation decisions and taking a long view and not sort of frozen by the instant.
And essentially a third party that isn't emotionally connected to your capital, but has seen it before perhaps, and knows how to invest into these areas where people often fear. So fair enough.
Absolutely.
Sure. Okay. And so some terrific outlooks there and our playbook. But if we have a look at our own portfolios, let's bring up a graph of where the Nucleus portfolio is sitting.
Yes, this is giving you a feel. This is I've grabbed some charts from our growth portfolio, which is our sort of most aggressive portfolio. And its target is to run at sort of about a 90% exposure to equities and 10% to cash and bonds.
Okay, sure.
So it's a very high risk portfolio, and it's one geared for very much for growth investors, and that's just indicating to you that so that's sort of showing that the bounds of it. What I've got on that chart is showing you where we are now, and so right now we're running more like 35% cash and bonds.
Okay, wow. Yep.
So we're significantly overweight these cash and bonds, more so cash than bonds.
Okay.
We do. There's a long story behind that, and we did an interest rate one earlier, but I guess there's a relative rate issue that we've got. We do think Australian rates aren't headed higher for a long time, and could quite possibly see another fall. But we're expecting US rates to rise, and there's a bit of relative argument there, sort of saying why we're sort of more in the cash than the bonds.
Okay, sure.
On the equity side, we're basically back to our minimum weight in terms of Aussie stocks, and we're a little bit overweight international. But the net effect is a conservative portfolio at the moment, and just basically saying, look, it's late cycle. No time to be a hero.
Yep.
Let's just make sure that you've got the assets so that when things do, you want to stick with the market if it does extend for another 2-3 years.
Absolutely.
But have the protection that it's not, you're not liquidating an entire portfolio if things start to turn.
And have your war chest there for pullbacks to dip into.
Exactly.
Fantastic. Okay, very good. And then I guess whilst we're on the theme of investment outlooks, let's look on local shores here, where I guess our main economy drivers are headed.
Yeah, so specifically in Australia, the types of things we're investing in, resources, look, there's some positivity from the Aussie dollar falling. The flip side is the negative side from China slowing, sorry. And so, there's certainly a right time to buy resources within our framework. We're still at the not yet stage.
Okay.
I think so. So it's an area we're looking at, but I'd like to see a bit more negativity out of China and a bit more of a slowdown in actual prices, and then we might and a fall in the actual the stock prices, and then we'll probably have a look at those.
Okay.
Property is very hard to find positives. I think the best case you can have is this long, slow sideways grind. I mean, which is possible.
Yep.
But you can certainly see cases where external shocks or something, and you end up with a housing crash, and a property crash. So it's not just all; it's other property assets as well. So
absolutely, yep.
So the top three sort of areas of the Australian stock market, resources, property, and banks, are all sort of exposed to those similar types of things. On the bank side, look, as I said, an Australian housing crash is possible. And so, you need to be ready that if we do start going into an Australian housing crash, I know the banks pay big dividends, and the yields are going to look even better when you
when the price falls.
When the price falls, it's there will be a time. If that's the scenario you're going into, then don't be scared to really pull back on those banks. We're mildly underweight at the moment.
Yep.
We think there could still be a bit longer to run, but I think the banking sector is one area where you just need to be extremely vigilant, and especially there's a lot of retail investors sitting on quite big gains, and they like the yields that come out of it, and that's great. But don't forget that banks are highly leveraged; they're extremely exposed to the Australian housing market, and
and foreign funding as well.
Yeah, and that don't sort of be too. Some people get hung up over, I won't sell that because I raised some capital gain or something like that. Is that,
a bird in the hand's worth two in the bush.
Yeah, paying a little bit of extra tax sometimes is is much better than wearing a loss. Yeah.
And I guess the other thought with the banks as well is that given that a share price is essentially an estimate of a company's value in the future, and the banks having such a huge exposure to a cooling Australian market is to then put the hat on as a bank to say, well, where am I going to get my next boom like income source from? Would that be a fair assumption? Is that something that the market would calculate into a share price?
Yeah, absolutely. Yeah, and then the last one we've got is these dollar exposed industrials that we've been on a play for a long time.
An example of a dollar exposed industrial for those
CSL, Cochlear, Treasury Wines, anyone who's an exporter or has most of their sales overseas.
Okay, sure.
So they're sort of benefiting because the Aussie dollar falls and they earn a higher amount, so that's been a great trade. We've been on that one for a long time. Unfortunately, these stocks are getting so expensive, and I wish they weren't as expensive because I'd still own lots of them. But we've actually just started to tip out of a few just because at a certain stage you've just got to say, well, yes, I like the exposure, I like the fundamentals, I think the profits are going to grow much better, but do I really want to be paying 35 times earnings for something that's yes, I like the fundamentals, but everything's got a price.
Do I want to be the last one at a crowded party sort of thing? Last one standing.
Yeah, exactly. And it's just more that point that's saying, look, even if they might hold up all right in the scenario of falling dollar, they'll probably hold up all right. But it's just that valuation argument of saying, I need to have something I need to have a safety margin, and I need to feel as if there's I've got something behind it. If you do have a market shakeout, the stocks that are trading at 35 are they're the ones that are really going to get smashed when you do have market sort of turmoil.
Okay, very good. And on that note of investing on the value basis, I'll bring up our final slide for our seminar today, which is a very commonly seen one in our office, but maybe not so much in our broader maybe readership. But we'll quickly run through how we sort of select stocks in our portfolios, or what helps us to.
Yeah. So I spoke about what to do on Aussie stocks. The idea about what to do on international stocks is then it's a little bit harder. You've got such a broad world, and it's over a 10-year period, markets will go higher and lower, and so there's not a sort of an overall outlook that you can sort of say jump on these. At the moment, the things we're looking to buy are stocks that are high quality and high value. And that's our general thing is we put everything on this matrix where we look at value on one axis, we look at quality on one axis, and we buy everything in that in a triangle of stocks that are a mixture of high quality and or value
and good value.
So I'm happy to pay a little bit expensive price for something that's very, very high quality.
Yep.
And I'm happy to buy something that's only of average quality if it's really, really cheap.
Sure.
But there's a matrix you need to play with, and ideally you're looking for stuff that's both quality and high quality and cheap. Its problem is those stocks are pretty rare.
Yep. Okay. And hence the need for the active piece and the research behind everything. So
so that's the idea. And so the idea for me is that right now in the cycle is actually the best time to be buying these stocks anyway, because when you're late cycle, what these stocks tend to do is that they do tend to outperform over time, but the outperformance comes from performing with the market when the markets are rising. Probably a little bit underperforming when markets really go into blow off.
Okay.
But then when they pull back, that's when you make up the difference.
So actually, there's sort of inbuilt protection on the downside because of the quality.
Yeah, and so a good example. Look, our international portfolio over the last over February to date is that the world market's sort of down about 1.5% ish
after that early February rout.
Yep, yes, sure. And our international portfolio is up a little bit.
Wow.
Points. So it's the idea that. We want to find stocks that benefit from that. And on the flip side, though, we didn't participate in that blow off we saw at the end of January, where markets sort of went vertical for a couple of days.
Yep. Is
that our portfolio underperformed that point and then made it back on the downside. And that's the idea: is you want to smooth a ride for these things and pick up that performance by trading off that value and quality. So the type of stocks that have really helped us. I mean, it's ironic. I was just seeing the Scandinavians, they're very much at the top of the medal count in the Winter Olympics at the moment. I think Finland's sort of lapping everyone else.
Yep.
And they're actually the stocks that actually held up our portfolio over the last couple of weeks as well. We've had some real benefits, and we've been trying to find stocks that are not listed in the US because we don't want to pay up for it, but have US exposure in terms of economic exposure.
Okay.
So we want exposure to that boom, but we don't want to have to pay up for it.
Mm.
And so we've been sort of scouting through peripheral markets, and a lot of them tended to be in Norway, Finland, Denmark.
And this is a joke, but is it just because people have realised those countries exist thanks to the Winter Olympics and they've decided to invest? Or no, surely not.
Possibly there's some there's some focus back onto that. And look, some of those stocks we're just getting to the stage where it's a bit similar with the dollar exposed in industrials. So just throwing your hands up and going, look, I'd love to keep owning them. The stock's good quality and all that type of stuff, but at a certain stage the price goes up so far, you've just got to take a step back and lift that one off and go back to the end and go back to the next stock, and if the price then falls, we'll pick it up again.
Okay, sure. All right.
So so I think the key though on the international side, getting that diversification is that real key. Don't try and chase the growth stocks at this point in the cycle. If you want to, some people like to chase the growth stocks and get that real upside in some markets and down, but conversely you get the real downside as markets come off. If you're going to pick a time, if I was going to pick a time to play in the growth area, it wouldn't be now.
Wouldn't be late cycle.
Yeah.
Yep.
I'm much happier sticking quality and growth, through the cycle. But even if you are a growth investor, now's not the time to be chasing those returns.
Okay, fantastic. Wonderful. All right. Well, look, that is our final slide for today's presentation. And thanks very much, Damien, for your wise words and outlooks for given our decade that's facing Australian investors and of course, where to look for potential opportunities. We'll just jump into a little bit about, of course, Nucleus Wealth and what we do. And, make sure that you check us out if you'd like to invest with us in the future. So, Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about. And these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. And just finally, of course, stay tuned for our next webinar presentation, which will be same bat time, same bat channel at 12:30 next Thursday, which will be entitled Quant Rocks for Picking Stocks, in which Damien and I will be discussing the quantitative methods, a little bit of 101 at the start, just for people who want to brush up on exactly what quantitative investment management is and analysis is, and then we'll dive into how we apply that every day at Nucleus Wealth. So we'll catch you then, and of course, Maddie, our communication expert, will be sending out our survey on how we've gone today. Please feel free to give us some feedback and also any topics you'd like for us to discuss going forward. So on that note, thanks very much for your attendance, and we look forward to catching you at the next one. Cheers.